When is the right time to buy the dip? Right now, the market is dipping pretty hard. But if you bought this initial dip here, you were too early. Maybe you even tried to play some of these sort of support levels here and here. You were still too early. The market still kept dipping another 20 and 30 points from these levels. Well, I have a custom coded study running on the chart behind me here that shows the percent drawdown levels that are specified by the user from highs. And what we're going to do today is we are going to utilize this and build a strategy around this to find when actually is the best time to buy the dip. Quickly before we jump into it, I have to let you know that this custom built study is already available over on my website, daytradingstrategies.net. The site is linked in the description down below, and it contains over 140 custom ThinkorSwim coded strategies, scanners, studies, etc. And they are all extremely easy to import into your own ThinkorSwim. Every single code comes with a TOS share link like this. All you do is you copy that link back within your ThinkorSwim application, set up in the top right, open shared item, paste, preview, and import. Since I just imported a study, I turn it on just like I do any other study. It was the DTS Bollinger break. Double click to add it to the chart. That custom code is now saved locally within your ThinkorSwim forever. And it's just that easy to get turned on. In about 5 seconds and 3 mouse clicks, you can have all 140 studies and other codes from my site into your own ThinkorSwim. Once again, linked in the description down below. So let's talk about the optics of this custom code first, exactly how it works and how you can set it up and fully customize it. So into, once again, my edit studies modal, I am running the custom code. I call it my percent down from high study. If I click into the settings cog of this study, you will see some input parameters here. The first is day length. This is what are we taking the high value of? Out of the last X number of bars back, are we comparing the drawdown from the high of? Default is set to 100. You could set it to something like, if I set it to 20 instead, you'll notice these lines adjust a lot faster because it's comparing based off of the highest high value out of the last 20 bars rather than the last 120. Then you have 4 input variables for percent lengths. As you'll notice, there are 4 lines plotted on the chart, and this is where you can dictate and customize at what percentage from the 120 bar high should the drawdown line be drawn at. By default, 3%, 5%, 10%, and 22%. If you wanted to instead go like 5, 10, 20, and 30, you could just very easily do that. All you have to do is change the variables in these inputs. And if I apply this, you will notice the lines now change to represent the drawdowns based off of those percent values. I also just want to let you know down here in the plot section, first off, if you don't want to see 4, like maybe you only want to see 1 line, we're going to build a strategy later in this video, and that's going to sort of help us decide maybe which percent drawdown works the best. Maybe you only want to see that one. You can go through to chart percent 2. You can uncheck show plot 3, uncheck 4, uncheck. Now you only have that one drawdown line. Of course, if you only want to see 2, you can do that. You only want to see 3, etc., etc. You can do that to turn on or off plots. Also, if you would like them to be different colors so they stand out a little bit more, you of course can come in and change the color of each plot here as well. So if I run this now, of course, all 4 different colors just to help them stand out a little bit. And that's really all the customization, at least on the front end, that you need to know about this code. So now let's begin building some strategies around dip buying utilizing this custom study. The strategy I'm going to focus on building for this video is going to be an investing and or swing trading strategy. So I'm going to focus on the drawdown percents on the daily chart. I just want to showcase that this study, however, will run on any time frame. So if you were more of a day trader and you wanted to maybe hop down into the 15-minute chart, you can see, of course, the indicator is still running here based off of the high value of the last 120 bars and the percent change drawdowns from such. Of course, if you were running an intraday chart, you'd probably want to tighten up your drawdowns, maybe like 1, 2, 3, and 5, something like that. I mean, SPY is not going to like draw down 20% in 120 15-minute bars, probably not. So you could sort of tighten it up and have it work out like this. But just an idea, just something I wanted to showcase. Once again, what we're going to do is we are going to raise back out those values and focus on the daily chart today. Let's take a look here at the SPY daily, and let's take a look at how the chart reacts to even these default percent drawdown levels. This is where we're going to start building our strategy. As if you don't know, SPY is an ETF that tracks the price of the S&P 500. So this is the overall market. This is the top 500 stocks in the stock market. This is the price of them. When people talk about the market, they are very often talking about this chart. So if we can find a way to objectively define the best opportunities to buy dips on this chart, we're going to do okay on any stock that we are looking to trade. So just taking a look at this thing, I mean, it definitely doesn't always bounce off the top line, right? Remember that top line is it 2 or 3%? I believe it's 3%. Yeah, that top line is a 3% drawdown. Then we have 5%, then 10, then 22. So oftentimes we break through that kind of 3%. You can see that 3% drawdown is maybe sort of reserved for like these quick dips, right? Like kind of the quick hitters, bang, they sort of bounce around this 3% level. Then when you get sort of larger pullbacks, I would consider a 5% drawdown a pullback, you actually tend to get some nice reaction around there. I mean, you got to bounce here, you got to bounce here, although obviously even before failing, that 10% level is correction. There are actual defined terms for a correction and a bear market when it comes to stocks. A correction is 10% from highs, a bear market is 20% from highs. So it's nice to have those visualized on the chart. As you can see, even here reacted off of 5%, went back up towards highs, then fell down to correction, bounced nicely. Bounced off 5%, bounced off 3%, bounced off 5% twice here. It even bounced off 5% here locally. It bounced right off that 5, gave you a nice, actually big green day here before again failing down to that 10% correction level. And we got a nice bounce off that 10% correction level, got a 5% bounce. You wouldn't be angry about a 5% bounce, capturing that visually right off of this study. And so far, who knows where we're going to go from here? Now we're talking about live data, but so far we are getting a second bounce again off this 10% level. Kind of looks a lot like it did back here, correct? Sort of that double bottom off of a percent level like this. So what I want to do first, kind of the first idea that jumps into my mind when I'm looking at this chart is let's build a strategy that scales in at each one of these percent down levels. So we'll just start with the default and we can adjust it as we go, but we'll start with the default. Let's buy some shares at 3%. Let's buy some shares at 5%. Let's buy some at 10. Let's buy some at 20. And then from there, we will sell when it breaks back up above highs. That's the first idea I'm going to go with a strategy, and we'll optimize from there. All right, so I've got the beginning of the strategy built, and I just want to quickly show you how I did it. So what we have going on here, I have shares being bought when the current candle low breaks below our first drawdown line here. Then I have it selling when we break highs. And it's based off of the day length parameter here set within the strategy, which highs we need to be breaking above. So since the default is 120 days, that's what we are comparing our drawdown against. When we break the 120-day high, that's when we are locking in profit. All I did, if I come into the code here and scroll down at the bottom of the code, so I actually just copy and pasted in the code from the study. And at the bottom, I placed in a buy variable, of course, buy when the low is less than my %1, which is the variable that stores the calculation for our first drawdown level there based off of our %1 input variable. When that is true, we enter. When the close is greater than the highest high value out of the last day length variable, then we exit. Also, you will notice I have added one more input variable to this code being position size. By default, I've set it to 5,000. This means that I am entering $5,000 worth of shares at each interval. Right now, I only have one interval, but here in a second, I'm going to build so that we buy when any of these percent lines are crossed below. So you can see here when SPY is trading at $549, I buy 9 shares. That is what the little number underneath the buy icon here represents, the number of shares you are buying. Of course, 5,000 evenly divides into 549, 9 times without overflowing. That's why we buy that many shares. Okay, now what I'm going to do is I'm going to, once again, build out so that we buy when each of these percent drawdowns is broken below. So what's going to end up happening is we're going to scale into position. So as you can see, actually, currently on the current drawdown that the market is going through, we bought at 594. That's the first drawdown indicator. I want the strategy to then buy again when this line broke down at 583 and buy again when this line broke down at 551. So we should be scaling into this position on the way down. Let's go ahead and get that set up now. All right, so I've got the strategy working like I would like now. When the first pull down line is crossed below, you make your initial order. When that second pullback line is broken below, you make your first add. When that third pull down line is broken, you make your second add. And if there were a case in which this bottom line would be broken, you would make a third add. You can see here the statistics of its performance on the SPY daily chart, once again, with this being the default levels of 3, 5, 10, and 22. Now, as you notice here, when I open up the studies modal, what I had to do was I had to create 4 strategies, actually. I had to essentially create a strategy for each one of these entrances. So if I come into pullback add 1 here, if I come into the source code, you'll see I've got my buy set when the low crosses below my %2, being that second drawdown line. The add 2 will, of course, be the low crosses below my %3, etc., etc. And within ThinkorSwim, the way you set this up so that multiple orders in the same direction are allowed, you come into this global strategy settings, and I allowed up to 4 entry orders in the same direction when the order is generated by a different entry order. And that is exactly why I had to create 4 separate strategies for this, because when you check regardless of the entry that generated the order, what ends up happening is that, so say even right here, when you cross below the first line, you would buy. When you cross below this line, you would buy. But because it then bounces and crosses back below this line again, you would buy again. When it bounces and crosses back below this line again, you would buy again. So that's what ends up happening when, should I say, I tried to build this code all in one encompassing strategy. So the 4 strategies works just as easily. You'll just have to import, should I say, all 4 of these. I will put all the share codes for all 4 strategies in the document. All you got to do, add all 4, run all 4, and make sure your global strategy settings looks like this. I will note that sort of one more annoying thing with this is if you want to go test and optimize, which of course you will want to do, you will want to test, well, what if we look at 2%, 3%, 7%, and 10%? What you need to do is you'll need to then make sure all those numbers match across each strategy, right? Which once again, slightly annoying, but let me tell you the alternative. The alternative to backtesting in this way is that you have to go through, and every single time one of these orders appears on your chart, you have to go through and manually write it down and manually perform the statistics calculations. And whenever you want to optimize, you have to do the whole process over again. So yes, while needing to update the parameters in 4 code is slightly annoying, I promise you it's still 10x, 100x faster than manually backtesting, and that is the power of code. And I just want to point out one more thing as well. These backtest statistic labels you're seeing up here, this is also a custom study that I built. It's extremely helpful. It gives you obviously real-time statistics on the strategy that you are running so that when you are optimizing and testing, when you're looking at different percent change pullback levels, when you're running the strategy yourself, if you also have my backtest labels turned on, you will get immediate feedback on whether the change you made is better or worse than before. Rather than having to come in and pull the report, this is what you would normally have to do. You'd have to export this report, put it in Excel, format it in Excel, perform the calculations in Excel. With this custom study turned on, once again, another one available over on the website, wink, wink, it speeds up that process. It does it all automatically for you directly within your ThinkorSwim chart. So I've gone ahead and I've actually adjusted my pullback parameters to 2%, 3%, 7%, and 10% on all 4 of my strategies. So really we've tightened up the amount of pullback necessary to scale in 2 positions. And as you can see now, total P&L jumps up to 37%, win rate sits at 88%, and the max drawdown percentage is still less than 20%. So it looks very good. But here's just sort of, once again, an idea of the usefulness of this strategy. You can take these input parameters, adjust them to whatever you feel works best, right? You can even shorten up the day length, etc., etc. Everybody watching this video is going to have different goals in trading and different risk management procedures. The point of all my custom codes that I build and publish is to make them as customizable as possible. So once you import these strategies, you can adjust them yourself. I just wanted to show you sort of what that looks like. And also here, you can actually see an example of that third add happening when the 4th and final percent drawdown line gets broken below. So initial buy, add when that 3rd drawdown is broken, add when that 4th drawdown is broken, sell when the close closes above the highest high print out of the last 120 bars. Of course, we've been talking about the statistics here on an S&P 500 ETF, and I think this could be a good way to take advantage of index funds just like the S&P. If I go look at the statistics on QQQ, this being a NASDAQ ETF, you can see here up $26,000 on an 89% win rate. If we go look at IWM, this being an ETF for the Russell 2000, you can see up $32,000 and a 91% win rate. So once again, I think this could be a pretty good strategy for attacking and trading index funds. Index funds are rebalanced quarterly so that always the strongest stocks within them have the largest influence. Basically, they are built to always go up. Does that mean they do always go up or will always go up? No, but they are constantly adjusted so that they have a better chance of bouncing at all times. And I say better chance in comparison to individual stocks. Like, let's go look at something like Tesla. This, of course, has been a very volatile name and actually up $56,000 and an 85% win rate. Actually a little bit better than I expected because I was thinking that this is what the chart was going to look like right now. We have entered, and Tesla's still getting slapped up. And as you can see back here, got pretty slapped up here on this trade as well. But I guess because Tesla's performing so well, even over time, it still works okay. What's another bad name I can look at? XYZ. Absolutely slapped up in this trade here. The strategy doesn't have a stop loss. Now, there's probably people saying, well, Trey, why don't you build a stop loss? Whenever I build reversal strategies like this, I have found, I've been doing this now for a while. We're coming up, actually, it's probably been 5 years now. I pretty much started coding in ThinkorSwim during lockdown, which we're kind of in the 5-year anniversary of right now. So I've been coding strategies in ThinkorSwim for 5 years. I've found that when building reversal strategies like this, not having a stop loss is the best way to make the most money. Now, that of course puts you at risk of getting slapped in trades, but it averages out over time to be better because you're going to make more money when it works. It's going to offset the eventual big loss that comes. And as I always say, returning subscribers to this channel will have heard me say this multiple times. Really, the only reason you're allowed to make money in the stock market is because you accept some kind of risk. Every single profitable strategy has some kind of major downside. In reversal trading, it is the fact that you can get slapped in some trades. You will take some trades that are big losers, but you're targeting that high win percentage. So over time, it offsets. In continuation trading, the major drawdown is that you can go through a really cold streak. You're not getting such large win percentages in continuation trading, so you can take 7, 8, 9, 10 losers in a row. And as I always preach, I'm a big believer in that you should be trading both kinds of strategies so that they help offset the cons of one another to help give your own portfolio more of that constant up and to the right shape. Anyway, that's my take on why there's no stop loss in this strategy, and just sort of a showcase that, yes, guess what? You can take big losers, especially if you're going to go to individual names outside of ETFs. Yes, you can take big losers. It's going to happen. That's part of reversal trading. That's the risk of reversal trading. The goal and where you're profitable is that the win percentage is so high that even though you can take a large average loss, your average loss versus average win tends to be pretty large, it still profits over time. And this strategy seems to do that. Strategy seems to do a good job of offsetting the major losers with the high win percentage to still be profitable. And once again, just so you know, this code, all the codes, all 4 of the strategies you need to run, if of course you would like to add up to 3 times to your percent pullback, is already available for easy import into your own ThinkorSwim over on my website, daytradingstrategies.net. Within the ThinkorSwim strategies, into the swing trading strategies like you saw me just do, the percent pullback link is here. Once again, 4 share links and the source code all exist within this so that you can import all the strategies. And also, I will put a link directly to this page in the description of this video for current members to easily find it. Anyway, guys, you get access to all 140 custom ThinkorSwim codes on my website for only $35 a month. And since you watch this video all the way to the end, I'll give you a little extra push. I really want to help you guys that are taking the time to watch my videos. I really want to help you all take that next step in your trading journey. Really look into systematic trading, as that's really what made me a profitable trader. So if you use discount code END, your first month is only $25. I did the math on that at some point. I think it's like 17 cents a code, something ridiculous like that. I do have my membership set up as a subscription, as I am always adding and updating new codes to the website as the market is ever changing, right? There's no such thing as a strategy that will always work in the market. There's always different market conditions. So if you remain subscribed, you continue to get access to the new codes. Of course, if you just want to subscribe, download what's currently there, and then cancel, you can easily do that with just 3 mouse clicks under the My Account tab. I don't make it hard. I'm not trying to lock you in. It's not a scam, anything like that. I promise. Daytradingstrategies.net. Linked in the description down below. Go sign up and become a better trader today. Hopefully you guys enjoyed this video. Hopefully the members of the website, which there are currently over 1,500 of you all. First off, thank you all so much. I never expected this website to grow to this size. It really is amazing. You're changing the life of me and my family, and hopefully I'm helping to bring you some value along the way as well. But anyway, hopefully you guys are able to take this study, take this strategy, and make some use of it. You know, pull some ideas from it that you are able to incorporate into your own trading arsenal. If you learned something in this video, please take the half second, hit the like button. If you would like to continue learning, make sure you subscribe to the YouTube channel by hitting the red subscribe button down below. That's completely free, so why not do it? And with all that being said, I'm going to go ahead and sign out of this video, and I'll catch you all in the next one.